The SharesPost 100 Fund is an actively managed, closed-end interval fund which targets a curated list of 100 companies in the late-stage, venture-backed private space. I think the SharesPost 100 Fund is compelling because it gives access to all investors who are interested in the late-stage, venture-backed private space. The other compelling reason to invest in the SharesPost 100 Fund is because it gives liquidity to an asset class that has very little, if any, liquidity at all.
The key differences between early stage and late stage companies have to do with how robust and how well developed the business model is. By the time private companies achieve a late stage growth, they typically have revenues that are 50 million or above. They have demonstrated approximately 40 to 50% in cumulative annual growth rate, and they also have a very well-defined business model and diverse products and services, as well as a robust customer base. One characteristic of the growth of this market has been the birth of the term unicorn. Companies started to be called unicorns when they achieved a $1 billion valuation. Back in 2009, there was only one unicorn, Facebook. But by 2012, we had 23. Today, we have 260. So it's not such a rarity anymore.
There are two drivers that have made it easier for companies to stay private longer. One reason is that regulation has made it much easier for companies to stay in the private space. The other reason is that capital is much easier to access than it has been in the past.
I think with Sarbanes-Oxley coming into effect, it made it less attractive for companies to go public. And then in 2012, with the Jobs Act, private companies were also allowed to go out to a broader number of private investors. Another driver of the growth in this particular asset class has been the availability of financing. Following the global financial crisis, there was a real dip in private equity and venture capital being raised. But looking back over the last 10 years, there's been a dramatic expansion in capital available, especially in the late stage venture space. Back in 1999, a company stayed private on average 4 years. Now it's 10 years or more. Some of the challenges that have surfaced with companies having the ability to stay private longer is really a liquidity mismatch. The cash flow needs of a company rarely match up with the cash flow needs of employees and early investors who've either invested in the company or have been given restricted stock or options. At SharesPost, we are passionate about providing liquidity and access to this private growth marketplace. And as such, we created the SharesPost 100 Fund, which is managed by SP Investments Management, an affiliate of SharesPost Inc.
The SharesPost 100 Fund as an interval fund differs from a closed-end fund in a couple of important ways. First, as an interval fund, it's a continuously offered fund, and therefore it's priced at the end-of-day NAV, as opposed to a closed-end fund which trades on supply and demand in the secondary market on an exchange. The SharesPost 100 Fund offers quarterly liquidity to investors up to 5% of the net assets of the fund. We're investing in some well-known companies like Lyft, Uber, Pinterest, Palantir, as well as some companies that aren't as well known by the general investor, such as Lookout, Tenable Networks, or Inrix. But we're just as excited about these companies as well. Because it's registered under the 40 Act, it allows us to offer this fund to all investors. To learn more about the fund, we encourage you to come to our website or talk to your financial advisor.